Yo, what's up you guys? Welcome back to a new video. Today's video we are going to dissect that confusing NFP data, and I'll give you a nice detailed technical breakdown on the dollar index, GBP USD, Dow Jones, gold, and the Nasdaq 100. If you are new to the channel, a sub would be appreciated, as I provide valuable educational content on a daily basis. And if you do enjoy the content, then please do consider smashing that thumbs up button. Now we're going to start with Tuesday, right? On Tuesday, Jerome Powell came out and he said, whoa, guess what? We could potentially hike interest rates by a 0.50 basis point. One of the students of mine came out and said, you know what? Followed Powell's speech, which was on Tuesday. He hinted they might hike interest rates. So the indexes and gold dropped. So NFP might be negative. That's what he said on Wednesday. The job report is released on Friday and the report is completely negative. Now, how did he know that? Nobody knows. But one thing that we do know is that the jobs report came through negative. Now you might say and go, oh, but how do you mean the job report came through negative? My 100 Telegram group said it was positive. Well, you need to measure factual information with previous information, right? So for instance, if you want to compare your trading results based off what you did last week, you cannot compare it based off what you forecasted to determine whether you did good or bad. You compare it to what you've done the previous month. The dollar or the US added 504,000 jobs report, new jobs in Feb. In March, they added 311,000. That means that means more people had filed for unemployment, because we can see here the unemployment also dropped by 3.6%. So it dropped by 0.2%. So unemployment's going up. Now, why is this good for the index? I'll tell you why. Because when people are losing their job, that means inflation is easing, right? And when inflation eases, the Feds are less likely to hike interest rates as aggressive as anticipated. Now, what is the confusing part about all of this? This is what it is. On Tuesday, Powell came out and stocks stumble, yields climb on Fed rate hike fears. Yesterday, the US Fed hike rates by 25 basis point or 50 basis point. Now, keep in mind that on Tuesday, they were sure that the Feds were going to be aggressive with the interest rate hike. And then the Feds downgrade. They downgraded their odds of hiking interest rates by 0.50 basis point to below 50. Now, what does that mean? Okay, I'll explain to you what it means so that you don't just have to read a screenshot or something that I've taken from somewhere and just run it through my just let you read through stuff and not understand it. I'll explain to you what that means. It means that the market was spooked on Tuesday. First, look at this. The market was spooked on Tuesday. The market said, vroom, there. You can see there, Tuesday. The market was spooked when the Fed said, we have to go aggressive with interest rate hikes, and then the stock market took a tumble. Now, if you're sitting there and you're wondering, okay, but if the dollar weakened, why is the stock market also down? Is it not supposed to do what gold did? I'll explain to you exactly what had happened there. Now, the first thing we can see here on Tuesday, stocks stumble as fear rate hike fears. Boom. The jobs report come through negative. And then all of a sudden, the Fed goes, we don't know if we're going to hike interest rates as aggressive. And then the market says, well, if that's the case, we're not interested. But you know what's funny is that decision can only be made certain on Tuesday when the Fed releases the CPI data. The CPI data will give us an indication. Now, you need to listen to me properly. I'm going to give you two probability setups, right? If the CPI comes through higher, the Feds are going to continue with that 0.50 basis point hike, because then that means inflation is not cooling down. If the CPI data comes through lower, God forbids, then that means that the dollar is going to continue to the downside and something needs to stop it somewhere there at the bottom, and the price of gold will continue to increase, because then that means inflation slowing down and the Fed is less likely to hike interest rates as aggressively, meaning that investors are less likely to invest in the index and they're more likely to buy some gold. Now let's remove this, okay? Let's remove this as well. Now the reason why stocks were down, it says here Dow closes more than 300 points lower post worst week since June, as the Silicon Valley collapse sparks sell-off. Now it says here stocks stumble on Friday as the tech-focused lender Silicon Valley Bank shut down following losses in its bond portfolio, prompting the biggest bank failure since the global financial crisis and sending shockwaves through the banking sector. Now, if you were wondering why is the stock market down, why is the stock market down when there's a negative correlation between the two of these guys, then now you know, okay? Because why? The Silicon Valley Bank collapsed, and that sparked fears in investors. It's like, not here today and not now. Next week, we've got CPI, core retail, Empire Manufacturing Index, PPI, retail. Now we also got the prelim, the University of Michigan, the consumer sentiment, right? That's the only way how I know how to pronounce it. It's like saying UOM is just confusing. Now, we are just waiting for CPI data to be released. Now, we're going to start with the dollar index. Now, again, the market is being chased up and down due to uncertainty with what's going on. Gold rallied more than I can count on my fingers on Friday, closing a couple of accounts over there. But nobody's going to say anything, because they buy on the one demo and they sell on the other demo. Whichever goes into profit, that's the one that goes on to Instagram. Now, if we're going to start here with the dollar index, right? Now, the dollar index is obviously due for a correction. The market at the moment is currently testing strong support. From here, we obviously expect the market to pull back slightly before we could potentially see a continuation to the downside. Market also printed a massive impulse to the downside. After an impulse, you expect a correction. And the best way to measure that correction is by taking your Fibonacci from the high to the low of the impulse. And we do have a 61.8, which is known as the red line ratio. Basically, if the market hits this level, then the market should reject from it. Now, I do expect the index to slightly pull back going into next week, and then from there we obviously need to monitor the price action. As you can see, there's a very short move from the 61.8 to where it is now. It's about the 0.43% move to the upside. Now we can expect the market to clear that level before the CPI data comes through on Tuesday. Now, if we are expected to go bearish, the market would then print a head and shoulders pattern, which is considered a bearish pattern from a technical perspective. From there, we would then monitor the price action. If we get a higher CPI reading, then by all means, we can expect the market to continue higher. A lower CPI reading would then give us the exact pattern that it is that we are looking for. And basically, that means the dollar is going to continue the move to the downside. A higher CPI reading will definitely move the dollar even higher there once again as well. But those are after this first move had taken place, and then we can obviously start looking for other moves to take place from there as well. Next up, we do have GBP USD. Also, what we have over here, the market had just broken above a very strong structural level. This level over here acted as a level of support. The market came back, tested it as support did not hold, came back, tested it as resistance, broken above resistance. All of this resistance is now acting as support. The market then printed a massive impulse. After an impulse, you expect a correction, and the best way to measure that correction is by taking the Fibonacci from the low to the high of this massive impulse. Now you can see we have a 61.8 lining up perfectly with this previous resistance that is now acting as support. Now from where we can definitely expect the market to just pull back slightly, and then if we do get a higher CPI reading, this market is definitely going to break lower and continue to the move to the downside. But let's leave that for once the CPI data is being released there once it does come out as well. Let's do that. Next up, we've got the Dow Jones. Now, the Dow Jones is basically now set for, definitely set for clearance, right? Clearance to there, clearance to there. Now, the market printed a massive impulse, and apart from printing a massive impulse, the market also printed broken below the strong level of support. This support held 3 times in the past, or twice the support had held from, sorry guys, I think someone must sponsor me. It's okay. So from the 22nd of November, then we came in here at the 20th of December. We finally broken through in March. The market printed at impulse. If you take your Fibonacci from the high to the low, we do have a 0.382 pullback. The market also testing, almost about to test support. I do expect a pullback, and then from there again, I'll make another update for you guys for the next move, which is potentially going to be to the downside, because it's not like people is just going to forget that the bank of Silicon is going to collapse in the long term. The most high performing pair was gold. Gold printed this one bullish candle here. Just continue that move to the upside, but like every other market, there's always an impulse. You get a correction. The most recent price action that was developed and broken at gold would be this level over here. Now, the reason why I mark this level is because this is the level that the market had broken above and never basically came back to test. This level acted as support, broke below that, tested it as resistance, broken above that, support again, broke below support, came to test it as resistance, broken above resistance, support didn't hold, broke below support, came back to test it as resistance, broken above resistance. All of that resistance is now acting. There's a level of support. We also have this massive impulse. After an impulse, you expect a correction. If you take your Fibonacci from the low to the high, you can see we do have a 61.8 pullback that's allocated with this level over here. Now, the clearance on the index and the clearance on gold, I would probably say the best way to monitor this is to probably be quite aware of this level over here. This is the first level that we can expect gold to go and basically visit on Monday, and then from there, again, depending on the CPI data, gold could potentially break right through that. Then we could see what happens. CPI is due at 2:30 on Monday. Same thing we have here on the Nasdaq. The Nasdaq printed an equal low, and for those of you that please tell me 1, 2, 3, 4. Okay, and apart from that, the market also printed an information. Now, an information is considered a bearish pattern from a technical perspective. And after the information, you expect a pullback to the neckline before that continuation to the downside. The market printed an impulse. After an impulse, you expect a correction. To take your Fibonacci from the high to the low, we have a clearance of a 61.8 Fibonacci. It's lining up perfectly with the neckline of the information. Apart from that, we also have this previous level of support that got broken that we need to take in mind there as well. I do expect a correction on the Nasdaq, as we expect the market to correct itself before the continuation to the downside. But as always, we have to be reactive and not predictive. And then this is where I would like to see the market pull back to. But again, depending on what the CPI data reading tells us on Tuesday, I will give you guys another update on Wednesday. That's all from my side. Enjoy your weekend. Thank you for your time. And as always, cheers for years.